Hey there, savvy investors. Professor Best here, ready to dive into a hot topic, bonds versus commodities. Want to know which investment could better secure your financial future? Stick around because today, we're breaking it down in simple terms that anyone can understand. First up, let's talk about bonds. Imagine bonds as the reliable, steady friend in your investment journey. When you buy a bond, you're essentially lending money to the government or a corporation, and they promise to pay you back with interest. It's like getting a guaranteed paycheck every few months. Bonds are generally considered lower risk, which is perfect if you're looking for stability and want to avoid the roller coaster ride of the stock market. Now, picture commodities as the wild and adventurous sibling. They include natural resources like gold, oil, and agricultural products. Investing in commodities can feel like a high-stakes game. Prices can skyrocket or plummet based on global events, weather patterns, or even changes in consumer demand. This means they can offer high rewards, but also come with significant risks. So, what should you choose? Let's break it down with a few key factors: risk tolerance, time horizon, and financial goals. First, think about your risk tolerance. Are you someone who prefers to play it safe? Or are you ready to take on some risk for potentially higher rewards? If you lean towards safety, bonds might be your best bet. They're less volatile and provide steady income. However, if you have a higher risk tolerance and are excited by the potential for big gains, commodities could be worth exploring. Just remember, with great rewards often come great risks. Next, consider your time horizon. Are you investing for a short-term goal, like buying a car next year? Or are you looking to build wealth for retirement decades down the line? Bonds typically shine for short to medium-term goals because of their predictability. They're like a dependable bus that always arrives on time. Commodities, on the other hand, might be better suited for long-term investors who can weather the ups and downs. Finally, think about your financial goals. If your main aim is to preserve capital and generate consistent income, bonds will likely align better with your objectives. But if you're looking to diversify your portfolio and are ready to embrace some risk for potential high returns, commodities can add an exciting twist. Let's wrap this up with a quick example. Imagine you invested $1,000 in a bond with a 5% interest rate. In 5 years, you'd have earned $250 in interest. Now, let's say you invested that same $1,000 in gold during a bull market. If gold prices soared, you could have turned that investment into $1,500. But keep in mind, during a downturn, that same investment could drop significantly, leaving you with a much smaller return or even a loss. Key takeaway: bonds offer stability and consistent income, while commodities provide the thrill of potential high returns but with increased risk. Your choice really comes down to your personal preferences, goals, and how much risk you're willing to handle. So, are you team bonds or team commodities? I want to hear your thoughts. Drop a comment below and let us know which investment strategy resonates with you. And don't forget to hit that like button if you found this video helpful. Next time, we're diving into another exciting topic that could reshape your investment strategy. Trust me, you won't want to miss it. Until then, keep learning, keep investing, and remember, your financial future is in your hands.